Starting this Thursday, the 1st of July 2026, if your total super balance is above $3 million, an extra 15% tax lands on every dollar of earnings above that line. That is what the government calls the wealthy threshold. But the announcement left out two things. First, this tax applies to unrealized capital gains inside your fund. Your property goes up in value. You have not sold it. The tax bill arrives anyway. Second, the $3 million threshold is not indexed to inflation. It stays fixed while your balance grows and prices rise. By the time you are 75, that threshold could represent half the purchasing power it represents today. That is the mechanism, and that is the first thing you are quietly losing. But before you switch off because $3 million feels out of reach, stay with me. Because the 1st of July also brought changes that hit every Australian super account regardless of balance. Higher contribution caps. A new requirement for employers to pay your super within 7 business days of each payday instead of quarterly. A ban on new SMSF residential property borrowing that closes in mid-August. And buried underneath all of that is one rule, the one that determines who gets your super tax free when you die. That could cost your family $68,000 or more if the paperwork is not right. In this video, I will show you what Division 296 costs in actual dollars, walk through the other changes from the 1st of July, and explain the one documentation step that most people skip even though it takes 15 minutes and could save 17% of your super balance. If you are over 55 with super above $1 million, these changes touch your retirement directly. Subscribe now. I am going to show you how to navigate them. Put some numbers to it. Imagine you are 62 and your total super balance across all accounts sits at $4 million. Your fund earns 8% this year. That is $320,000 in total earnings. 1/4 of your balance sits above the $3 million threshold, so 25% of those earnings, $80,000, gets hit with an extra 15% tax. That is $12,000 extra you lose this year without withdrawing a single dollar. Now here is what catches people off guard. That $80,000 is not just dividends and rent received. It includes unrealized gains, property that went up in value on paper but was never sold. If an asset in your SMSF appreciated by $100,000 this year, part of that paper gain gets counted as earnings for Division 296 purposes. You owe tax on a number you cannot spend yet. The mechanism works like this. At the end of each financial year, the ATO measures the change in your total super balance, adjusts for contributions in and withdrawals out, and treats the difference as earnings. The proportion of those earnings corresponding to the balance above $3 million gets taxed at an extra 15%. Run that forward over 10 years. At an 8% annual return, that $12,000 annual extra tax on our $4 million example compounds to over $165,000 in additional tax paid, and the threshold does not move. So each year, slightly more people quietly cross $3 million, not because they became genuinely wealthier, but simply because inflation pushed the numbers up. You might be sitting under $3 million today and thinking this section does not apply to you. It might not apply right now. But the same date, the 1st of July, also brought changes that affect every Australian super account, and one of them has a closing window that is already counting down. From the 1st of July 2026, the concessional contribution cap, your pre-tax super contributions, rises from $30,000 to $32,500. The non-concessional cap, after tax money going into super, increases from $120,000 to $130,000 per year. The bring forward rule, which allows you to contribute up to 3 years of non-concessional contributions in a single financial year, rises to a maximum of $390,000, up from $360,000, and the transfer balance cap, The limit on how much you can hold in retirement phase rises to $2.1 million. Those are genuine improvements. More room to build your balance in the years before you stop working. But on that same date, two other changes came into effect that push in the opposite direction. Payday Super is now a legal requirement. Your employer must pay your superannuation guarantee contributions within 7 business days of each payday, not once per quarter as before. For most employees, this simply means your super arrives faster and starts compounding sooner. But for small business owners, the compliance obligations tighten significantly. The bigger shift for SMSF members is the ban on new residential property borrowing. From approximately mid-August 2026, new limited recourse borrowing arrangements over residential property are prohibited inside SMSFs. If your fund already holds one of these arrangements, it is grandfathered. But if you are planning to set one up, that window is closing now and it will not reopen. The LRBA strategy for residential property inside super disappears permanently once that date passes. The fragility path here is clear enough. You see the higher contribution caps, feel reassured, and do nothing about the LRBA closure. Several weeks pass. You have permanently lost a strategy. The better path uses the higher non-concessional caps deliberately. Every after-tax dollar you put into super goes in as a tax-free component. When your super eventually pays out, whether in retirement or as a death benefit to your family, a higher tax-free component means less exposure to the 17% death benefit tax we are about to discuss. That is a structural advantage you can start building right now. The death benefit question is where I want to spend the rest of this video, because this is the one that costs the most, and the one that is most fixable with the right paperwork. I used to think a simple binding nomination to your kids was enough. Then I saw what happened to a client who assumed the same thing. Their 25-year-old son was in full-time study. They had done a binding nomination years earlier. But when the super was paid out after the member passed, the ATO applied tax to the full taxable component, $68,000 gone, because there was no documentation proving financial dependency. The nomination was correct. The beneficiary was named, but the proof of dependency was missing. I was wrong to assume that the nomination alone was enough to protect them. When you die, your super is paid to your nominated beneficiaries, and the tax on that payment depends entirely on whether those beneficiaries qualify as what the law calls a tax dependent. A tax dependent includes your spouse, any child under 18, or any person who was financially dependent on you at the time of your death. That last category, financially dependent adult children, is where most Australian families get caught. An adult child over 18 in full-time work and living independently does not automatically qualify. The ATO looks for evidence of actual financial support, more than approximately $5,000 per year flowing from you to them, not a general statement of intent. Actual documentation, bank transfers, rent payments, health insurance premiums paid on their behalf, regular contributions to their living costs. Children with a permanent disability can also qualify, but you need a medical practitioner's letter confirming that the disability meets the relevant legal definition, specifically permanent or long-term incapacity to engage in gainful employment. Now put numbers to it. Say your super fund has a taxable component of $400,000. If that is paid to an adult child who does not qualify as a tax dependent, the tax bill is 17% of $400,000. That is $68,000 paid to the ATO instead of your family. If the same child qualifies, the tax is zero. Same super, same beneficiary. One piece of documentation changes everything. There is also a structural strategy worth considering if you are under 75 and still able to contribute. The recontribution strategy works in stages. You withdraw money from your super, which removes both the taxable and tax-free components proportionally, and then recontribute that same amount as non-concessional contributions which go back in as 100% tax-free. Over several years, this deliberately tilts your super balance toward the tax-free component. Less taxable component means less exposure to the 17% tax, regardless of who eventually receives the benefit. There is also a new ATO draft ruling that may affect how testamentary trusts interact with death benefits in estate planning. If you have a testamentary trust in your will, it is worth getting specific advice on how that ruling could affect your family's tax position. The interaction there is more complex than what we can cover in a single video. But for most people watching, the single biggest win is simpler. Check whether your nomination is binding, check when it was last signed, and if you financially support an adult child, start keeping the evidence. Even with all of that in front of you, there is something that stops most people from acting. And it is not a lack of understanding. If you are sitting there thinking, I am 68, I have paid tax my whole life, and now I have to fill in more forms. I understand that completely. That is not laziness. That is exhaustion. The rules keep changing. New legislation lands every July. What used to feel straightforward, like naming your kids as super beneficiaries, turns out to have layers nobody told you about until it was too late. But I want to offer a different frame. The thing that stops most people from doing this paperwork is almost never the time required. The paperwork for updating a binding nomination is a 15-minute task. Gathering 6 months of bank statements showing transfers to an adult child takes perhaps an hour. What actually stops people is the psychological cost. The feeling of facing yet another chore when you already feel like the system has been making things harder than they should be for years. That is worth naming, because naming it is often enough to push through. The financial cost of not acting is specific. A missing piece of documentation on an adult child's financial dependency could mean $68,000 paid to the ATO instead of your family. That is not a hypothetical worst case. It happens regularly as super balances grow and nomination paperwork quietly lapses. I do not know every detail of your situation. Maybe you have a blended family, a child with a complex disability, or a defined benefit pension that interacts with your super in ways that genuinely need individual advice. If so, take this to a financial advisor who understands estate planning and super. Some situations need professional help, and recognizing that is not failure, it is good judgment. But for most people watching this, the situation is simpler than it feels. You have adult children. Part of your super is taxable. Your nomination paperwork may not have been updated in years. That is a 15-minute job. Pick one action today. Just the one. Update the nomination. That is enough of a start. The $3 million question and the contribution cap changes are real and worth understanding. But for the majority of people in this audience, none of those changes carry more financial risk than a binding nomination that lapsed 3 years ago and was never renewed. Start with the thing that is most fixable and the one that is already within reach. 3 steps. None of them require an advisor. Each has a number attached. Step 1. Check your total super balance. Log into your MyGov account, navigate to the ATO section, then to Super, then to the Information tab. Find your total super balance figure and write it down. If you are below $3 million, Division 296 does not affect you today. But track it each year, because the threshold does not move and your balance will keep growing. If you are already above $3 million, a conversation about the timing of contributions, pension drawdowns, and whether to move assets outside super is worth having before the 30th of June 2027. Step 2. Update your binding death benefit nomination. Call your super fund and ask whether your current beneficiary nomination is binding or non-binding. A binding nomination is a legal instruction the trustee must follow. A non-binding nomination is a request they can override. Then check the date it was signed. Many binding nominations lapse after 3 years. If your last nomination was signed before June 2023, it It may already be invalid. Request a new form, complete it, have it witnessed by two people who are not beneficiaries, sign it, and return it to the fund. That is the step. Step 3. Gather proof of financial dependency for any adult children you support. If you regularly transfer money to an adult child, paying their rent, covering their health insurance, contributing to their living costs, collect the evidence now. 6 months of bank statements showing those transfers is a solid starting point. The figure the ATO looks for is more than approximately $5,000 per year in genuine support. If you are providing more than that, documentation is what stands between your child receiving the super tax-free and receiving a tax bill instead. I had a client last month. We printed bank statements showing $350 per fortnight that he had been transferring to his daughter's account for rent assistance. That works out to $9,100 a year above the threshold. The ATO accepted the evidence, and the daughter received $400,000 from the super fund, completely tax-free instead of paying $68,000 in tax. One set of bank statements, pulled from online banking in 10 minutes, saved $68,000. You do not need to do all 3 of these today. Step 2, the nomination check, is free and takes 15 minutes. Start there. There are also longer-term decisions to consider around the re-contribution strategy, how the new non-concessional contribution caps interact with your age and balance, and whether Payday Super changes anything about your employer contribution timing. But those are second-order considerations. The nomination and the dependency documentation come first, and they are the ones most often skipped precisely because they feel administrative rather than financial. The tax outcome they control is entirely financial. 3 things changed on the 1st of July, 2026. Division 296 adds an extra 15% tax on the proportion of earnings above $3 million in total super balance, including unrealized gains on assets not yet sold. Contribution caps rose: $32,500 concessional, $130,000 non-concessional, $390,000 maximum under the bring forward rule. And Payday Super is now mandatory, with superannuation guarantee contributions required within 7 business days of each payday. The SMSF residential property borrowing ban arrives in mid-August, but the most valuable thing you can do right now has nothing to do with the new rules. It is about making sure the rules that already exist are working in your family's favor. Check your beneficiary nomination. Confirm it is binding and that it has not lapsed. If you financially support an adult child, document that support now, before it is needed. And if you are still building your super balance, the higher non-concessional contribution caps give you a cleaner path to tilt your fund toward the tax-free component, which protects your family regardless of what the tax environment looks like at the time of your death. You are not too old. You are not behind. The system is designed to feel more complicated than it actually is, and knowing a handful of specific numbers and mechanisms puts you well ahead of most people who never look this closely. If this video made you think differently about your super, subscribe. I am Bob, and this channel exists to help Australians over 55 keep more of what they have spent a lifetime building. No fear tactics, no noise, just the numbers and the mechanisms that matter. Drop a comment below with your biggest question about the $3 million tax. I will answer the top ones in a follow-up.